Debt, it's a word that brings stress, anxiety, and sleepless nights for millions of people. But what if I told you that managing debt isn't as scary as it seems? Whether it's credit card bills, student loans, or personal loans, today we're going to break down how you can take control of your finances and get out of debt faster. Stick around, because by the end of this video, you'll have a clear roadmap to financial freedom. Section 1. Understanding debt. Before we jump into solutions, let's first understand the different types of debt. 1. Good debt versus bad debt. Not all debt is bad. Mortgages and student loans can be considered investments in your future, while credit card debt and high interest personal loans can trap you in a cycle of payments. 2. Interest rates matter. The higher the interest rate, the more expensive the debt. Credit cards often have rates above 20%, while mortgages may be below 5%. Understanding what type of debt you have is the first step toward getting rid of it. Section 2. Creating a debt plan. Now, let's create a game plan to take back control of your finances. Here's what you need to do. 1. List all your debts. Write down every loan, credit card balance, and outstanding payment, along with interest rates and minimum payments. 2. Choose a repayment strategy. The snowball method. Pay off the smallest debt first for quick wins, then roll that payment into the next debt. The avalanche method. Focus on the highest interest debt first, saving you money in the long run. 3. Set a monthly budget. Cut unnecessary expenses and allocate more funds toward debt repayment. With the right plan, you'll be surprised at how fast you can start eliminating debt. Section 3. Smart strategies to pay off debt faster. If you want to speed up your journey to debt freedom, try these powerful strategies. 1. Make more than minimum payments. Paying just the minimum keeps you in debt longer. 2. Negotiate lower interest rates. Call your lenders and ask for a better rate. You'd be surprised how often this works. 3. Consolidate debt. Consider a balance transfer, credit card, or a debt consolidation loan to reduce interest. 4. Increase your income. Side hustles, freelancing, or selling unused items can provide extra cash to put toward debt. 5. Use windfalls wisely. Tax refunds, bonuses, or unexpected money should go toward paying off debt instead of splurging. These tactics can help you cut years off your debt repayment timeline. Section 4. Avoiding debt traps. Once you're on the path to debt freedom, the last thing you want is to fall back into the cycle. Avoid these common traps. 1. Living beyond your means. Stick to a budget and avoid unnecessary expenses. 2. Relying on credit cards. If you can't pay the full balance each month, rethink your spending habits. 3. Ignoring emergency savings. Financial cushion can prevent you from relying on debt when unexpected expenses arise. 4. Co-signing loans you can't afford. If the borrower defaults, you're responsible for the debt. By avoiding these pitfalls, you'll stay debt-free for the long haul. Debt doesn't have to control your life. With the right plan, strategies, and discipline, you can take charge of your finances and achieve financial freedom. Public debt, it's a term you often hear in news reports and economic discussions. But what does it really mean? Why do governments borrow money, and how do they manage it? Today, we're diving deep into the world of public debt management, how it works, why it matters, and how it impacts you. Section 1. What is public debt? At its core, public debt, also known as government debt, is the total amount of money a government owes to creditors. This debt is accumulated when a government spends more than it collects in revenue, leading to a budget deficit. To bridge this gap, governments issue debt instruments such as bonds, treasury bills, and loans from international financial institutions. Governments borrow money for a variety of reasons. Some of the key motives include funding infrastructure projects, stabilizing the economy during recessions, covering budget shortfalls, and responding to emergencies like pandemics or natural disasters. Borrowing allows a government to finance essential projects without imposing heavy taxes in the short term. Section 3. Types of public debt. Public debt can be categorized into two main types. Internal debt, money borrowed from within the country, typically from banks, businesses, and the general public through bonds. External debt, money borrowed from foreign lenders, international financial institutions like the IMF and World Bank, or other countries. Section 4. How public debt is managed. Public debt management (PDM) is a critical function of governments. The main goal is to ensure that the government can meet its financial obligations while keeping borrowing costs low and maintaining economic stability. Key strategies include debt issuance strategy. Governments choose between short-term and long-term debt instruments based on market conditions, refinancing and restructuring, managing debt maturities by rolling over debt or renegotiating terms, interest rate management, reducing interest costs by refinancing when rates are low, maintaining fiscal discipline, ensuring debt remains sustainable by controlling spending and boosting revenue. Section 5. Risks of public debt. While borrowing can stimulate economic growth, excessive debt can lead to serious problems, such as debt trap, when a country borrows more to repay previous loans, leading to unsustainable debt levels. High interest payments. A large portion of government revenue goes towards servicing debt instead of public services. Currency depreciation. Excessive external borrowing can weaken a nation's currency. Credit downgrades. If debt is mismanaged, credit rating agencies may lower a country's creditworthiness, increasing borrowing costs. Section 6. Successful debt management examples. Narrator. Some countries have excelled at managing public debt. For example, Norway uses revenue from all exports to maintain low debt levels. Germany enforces strict fiscal policies to keep debt sustainable. Singapore invests borrowed funds in productive assets, ensuring economic returns. Section 7. How public debt affects you. Public debt affects all of us. High debt levels can lead to higher taxes, reduced public spending, inflation, and economic instability. On the flip side, well-managed debt can lead to improved infrastructure, better public services, and economic growth. Public debt management is a delicate balancing act. While borrowing is necessary, responsible management ensures long-term economic stability. As citizens, staying informed about how governments handle debt is crucial, as it shapes our economic future. Bankruptcy, a word that carries fear, uncertainty, and often a sense of failure. But what does it really mean? Is it the end or a new beginning? In today's video, we'll break down the realities of bankruptcy, the different types, how it affects your financial future, and whether it's a path to avoid or embrace. Segment 1. What is bankruptcy? At its core, bankruptcy is a legal process that helps individuals and businesses eliminate or repay their debts under the protection of a court. It's not just about losing everything, it's about restructuring, resetting, and sometimes getting a second chance. Segment 2. Types of bankruptcy. Not all bankruptcies are the same. There are several types, but the most common ones are Chapter 7. Liquidation bankruptcy. This is for those who have little to no income. Assets may be sold to pay creditors, but some properties are exempt. After this process, most unsecured debts are wiped out. Chapter 13. Wage earners plan. If you have a steady income but are drowning in debt, this allows you to restructure your payments over 3 to 5 years without losing assets. Chapter 11. Business reorganization. This is mainly for businesses that want to stay operational while restructuring their debts. Think of companies like Hertz and JCPenney. They declared bankruptcy but continued running. Segment 3. The pros and cons of bankruptcy. Filing for bankruptcy has its pros and cons. Pros: eliminates overwhelming debt, stops collection calls and lawsuits, gives a fresh financial start. Cons: major impact on your credit score, can stay on your credit report for up to 10 years, may lose assets, depending on the type of bankruptcy. Segment 4. Myths about bankruptcy. Let's clear up some common misconceptions. Myth number 1. Bankruptcy means you'll lose everything. False. Many exemptions allow you to keep essentials like your home or car. Myth number 2. Bankruptcy ruins your financial future forever. False. Many people rebuild their credit in just a few years by making smart financial decisions. Myth number 3. Only irresponsible people file for bankruptcy. False. Medical bills, job loss, or unexpected emergencies are leading causes of bankruptcy. It's not just about bad spending habits. Segment 5. How to avoid bankruptcy. Bankruptcy isn't the only solution. Here are steps to avoid it. Create and stick to a realistic budget. Seek credit counseling or debt consolidation options. Negotiate payment plans with creditors before things spiral out of control. Segment 6. Should you file for bankruptcy? So, is bankruptcy right for you? If your debt is overwhelming, creditors are suing, and you see no way out, bankruptcy might be an option. But always consult a financial expert or lawyer before making a decision. Bankruptcy isn't the end, it's a chance for a new beginning. If you're struggling financially, don't panic. Learn your options, take control, and make informed decisions for a better future. Debt can feel like a never-ending cycle. No matter how much you pay, it seems like you're always behind. But what if I told you there's a way to break free, regain control, and achieve financial independence? Section 1. Understanding your debt. First, let's understand your debt. There are different kinds: high-interest debt, like credit cards; medium-interest debt, like personal loans; and low-interest debt, like mortgages. Knowing what you owe is the first step to creating a solid repayment strategy. List all your debts, including the balance, interest rate, and minimum payment. This will help you see the bigger picture and create an effective repayment plan. Section 2. Choosing a debt repayment strategy. There are two main debt repayment strategies: the debt snowball and the debt avalanche. The debt snowball method focuses on paying off the smallest debt first, while making minimum payments on the rest. This builds momentum and motivation as you quickly eliminate smaller debts. The debt avalanche method, on the other hand, prioritizes the highest interest debt first. While it takes discipline, this approach saves you the most money in the long run. Choose the method that works best for you. Section 3. Creating a budget to support your plan. Now that you've chosen your strategy, it's time to create a budget that supports it. Track your income and expenses and find areas where you can cut back. Small changes, like reducing dining out or subscription services, can free up money for debt repayment. Use budgeting tools and apps to stay on track and avoid unnecessary spending. Section 4. Boosting your income. Cutting expenses is one part of the equation, but increasing your income can accelerate your debt payoff. Consider side hustles, freelancing, or selling things you no longer need. Every extra dollar you earn can go toward your debt. Section 5. Negotiating lower interest rates. Did you know you can negotiate your interest rates? Call your creditors and ask for a lower rate. A simple phone call could save you hundreds or even thousands over time. Section 6. Avoiding common mistakes. Avoid common pitfalls like taking on new debt while trying to pay off old debt. Also, don't ignore emergency savings. Having a small cushion prevents you from relying on credit cards in case of unexpected expenses. Section 7. Staying motivated. Staying motivated is key. Track your progress, celebrate small victories, and remind yourself of your end goal: financial freedom. Becoming debt-free takes time and discipline, but it's possible. If you found this video helpful, don't forget to like, subscribe, and share it with someone who needs to hear this. Let's take control of our finances together. Managing debt isn't just about numbers. It's about taking control of your financial future. Whether you're tackling credit card balances, student loans, or other debts, The key is to have a clear plan, stay consistent, and make informed decisions. Remember, small changes today can lead to big results over time. If you found this video helpful, give it a thumbs up and subscribe for more tips on mastering your money. Got questions about debt or personal finance? Drop them in the comments. We're here to help. And if you're ready to take your debt management to the next level, check out the free resources linked in the description.